Hello, everyone. This is Elisa Baum, GridGain's Director of Product Marketing. We'll begin in just a moment, but I'd like to conduct just a bit of housekeeping. If you could please raise your hand using the hand icon located in the GoToWebinar control panel and let me know that you can hear me, I would really appreciate that. Okay, let's see. Can you all hear me? Okay, good. Next, during this webinar, you will be on mute. Should you have any questions during the discussion, please enter them in the questions field within the GoToWebinar control panel. At the end of the webinar, we will take time to answer as many questions as possible, and those that aren't addressed will be answered in a follow-up blog entry on GridGain's blog. In addition, a recording of this webinar will be made available to everyone within 48 hours. I'll send that via email along with links to the slide. I'd like to thank you for attending today's webinar, InMemory Computing to Achieve Real-Time Financial Regulatory Compliance. It's being presented by GridGain Director of Business Development, Eric Karpman. And Eric apologizes in advance. He's calling in from Moscow, so there may be some background noise. But we're hoping that it's a good, clear connection. And with that said, I will turn the floor over to Eric. Go ahead, Eric. Eric, can you hear me? You have to go unmute.
Okay, can you hear me?
I hear you now. Go ahead.
Sorry. Thank you, Lisa. Thank you, everybody, for joining me. This is going to be a second webinar in a series on various financial topics where we feel that GridGain's got an advantage and has a product that can solve some of the most pressing today's issues that are around us in the financial community. Last week we discussed overall financial case studies where GridGain helped to solve performance and scalability issues for largest financial institutions. In this webinar, I'll go over some of the financial issues and financial regulatory issues specifically, and then we'll go through again how GridGain can solve those issues. I will be speaking one way to you, but I would like it to be a bilateral communication. So please do send your questions through a panel there, or email me. You see that's email on the screen, ekarpman@gridgain.com. I'd love to hear back from you, what you think about those issues that we're discussing today, and what you think about some of the solutions to those issues that will be presented. So with that, let's move on to the next screen here. So the agenda is what I'd like to do. I'd like to provide slight outlook, my overview of the economic situation right now and how the banking industry is facing challenges that today's economy presents to us. And then I'll move on to various regulatory initiatives that I've worked with within the past couple of years, as well as some of the newest initiatives in 2016 and what's probably going to roll over to 2017. So I'll cover those in quite detail, and then we'll discuss how the banks are addressing some of those challenges and initiatives with some of the business strategies, as well as some of the new technologies that are here to resolve those issues. And then, if the time permits, I'll move into GridGain overview and how we think we can solve some of those issues with our platform. And I'll also present some of the use cases where we have actually done so for some of the larger financial institutions. And then there will be a chance for you to ask questions. So economic outlook, there's one word that I can come up with is uncertainty. We don't know what's awaiting for us. Every bank is sort of working together, but at the same time is alone in a boat trying to navigate through those rough waters of business challenges and market challenges that are there around us. So what is happening with the economic situation for 2016? Well, we've seen slight economic growth after crisis with low inflation, low interest rates. We've seen one of the slowest economic recovery in recorded history. Both developed markets as well as emerging markets are showing stagnation at best. Um, and the forecast is also quite pessimistic, right? We don't know, uh, where um, the profits, the economic benefits are going to come from. Anywhere in the world, there are issues. There are financial issues. There are global issues. There are geopolitical issues, currency issues. So Brexit, blah blah blah. There's a lot of things unknown. It's practically every week we are waking up to some news about one place of the world or another, showing us trouble cases of some sort, and that's what is really the banks are facing today and how they need to resolve this. Um, so we've seen the banking industry having its best days and worst days within the past 10 years or so, and basically, it's actually the top 10 global banks are showing return on equity below the normal 10%, and there's no more easy money like it used to be, and the banks need to allocate some reserves, which I'll show you shortly of how they do that, but basically it's the situation in which we operate right now. So what we've seen in the banking industry in the new post-2008 reality. It's basically, obviously, regulatory tightening, and we're going to talk more about that today, but it's in the US, EU, APAC, practically everywhere around the world, we see various regulatory regulatory changes addressing the crisis of 2007, 2008, and making sure that the countries and the industries in those economies are stable enough to withhold anything else happening. Shareholders are also losing money on bank stock shares. If we look at the banking ROE and the stock prices over 2015 and 17, we see that it's much lower than what we used to see historically with the banks, and again, that's sort of pressing the banks to actually act more cautiously in this environment. There is deleveraging, which basically reducing the debt and risky assets on the balance sheets, and I will show you in a second why this is important and why it affects regulatory challenges, of the banks. But the banks also need to address that to show that they are stable, they're not posing any risks in the financial situation of the economies in which they operate. Finally, there are compliance and penalties. We see it also on a monthly basis, if not more often than that, the banks basically are charged with this and that. Some of the issues going back to 2009, 2010, 2011 timeframe, and then so that what that means is going forward, the banks need to allocate larger percentages of their of the money that they have in their books to cover those compliance and penalty potential fines that may be coming down the line. So basically, litigation costs are severely driving the shares of prices of stock and shares of the various banking institutions. And fines exceeded at this point 230 billion US dollars, which is huge, which is more than capitalization of some of the largest banks combined. And investors see that investors try to sell banks. Investors are trying to reduce their banking holdings because of that, and that also drives the prices of the banking stock down. And again, banks need to respond. And how do they respond? Well, in multiple ways, right? The banks are trying to improve profitability and improve share prices. So they need to optimize certain business lines. We see all the time that certain, businesses are restructuring some, banks restructuring some of the businesses, combining some of the businesses together, trying to optimize costs around those business units. They need to, sometimes they exit certain activities, like sometimes they get out of the wealth management business, sometimes they get out of commodities business, sometimes they get out of equity businesses, and so on. Depending on how the market situation is around them, the banks basically decide to move one way or another. Also refocus on more profitable business. So again, if wealth management, for example, is more profitable at this point, then the banks are trying to move more into that, and then trying to yeah, sorry about that. So they're trying to refocus on wealth management, on adding more capital and more control towards different operational units, and implement automation and outsourcing within these processes. They're trying to cut costs basically, and with whichever way possible, they're doing that. Now let's move into the regulatory outlook situation. Basically, hold on one second. Should I move? Let me just hold on one second. Let me just try to move to another part of this institution to see if it's a little bit more quieter.
Hi, folks. Just to remind you, Eric is calling in from an internet cafe in Moscow, and apparently it's a very happening place at his time of night. So he's trying to find a little bit more quiet corner that he can talk
I
from.
think I found it. So
Okay,
I'm
great.
walking outside now.
Oh my goodness. Thank you.
Sorry about that. Right. So everybody okay? Everybody can hear me? The connection is good?
The connection's good.
Okay, perfect. Thank you. So basically, as I said, the banks are trying to, the regulators are trying to put more regulations around the banking institutions, and the banks need to comply. So what are some of the biggest ones that the banks are complying with today? So obviously it's Basel 3 and 4, and it's Basel in Europe, but there's also Federal Reserve regulations in the States, and they're all more or less centered around riskness of various assets that the banks hold in their portfolios, right? So they look at all of the assets, they weight by a riskness level, and then they come up with a certain level that certain exposure that the banks must comply with, must show, must reduce in order for them to be in compliance. So there's also a capital requirements directive that's coming up, which is a supervisory framework in the European Union, which reflects Basel III rules on capital minimum standards. So there are rules basically around what to hold, and like I said, in Basel III, the banks must hold reserved capital greater than 8% of their risk-weighted assets, and that's basically what you got with. So you are comparing, you're looking at different levels, you're trying to understand what you got, and you got to report on it. And what's important here is that you need to do this in pretty much real time. Even though you have to send reports to the regulators, every quarter or so, you still need to, on a daily basis, keep monitoring where you are so that you can respond to changes in the market, changes in the P&L, in the prices of different assets within the portfolio, different geographies that you may be investing into. So you got to really have a good handle on what you're having in your portfolio and how the events in the market are changing your overall riskness of different assets. Depending on the basically fluctuation of the prices and how long you've held this in your portfolio and so on. So all of this needs to be tracked in real time, and this is a lot of data. Think of a large financial institution that needs to address this. We're talking about all of the bank's assets analyzed on a real-time basis. That requires significant significant system expend on getting a system like this ready for compliance purposes. In the US, we're also not too far behind Basel's. We have CCCCR, which is a comprehensive capital analysis and review, which is a regulatory framework which was introduced by the Federal Reserve in order to assess, regulate, and supervise large banks. And it works similarly to Basel, where you actually are looking at all of the assets and how they are graded according to the riskness factor, as well as the a need of reporting this information to the Federal Reserve Bank, and there are special tests that need to be run, where basically you're putting in different scenarios. Okay, the interest rate is growing 10%, or the assets, your indices are down 20%, or your currency rate is changed significantly, and so on. So there are multiple scenarios that the bank has to go through and analyze how their portfolios, how their overall strength is acting based on those changes, on those stress testing. So again, what the bottom line here is that the system needs to be agile enough and scalable enough to allow for all of those stress testing scenarios to be performed and getting the results in real, in more or less real time, or within reasonable time to actually perform this and get the reports out. There's also another regulation called IHC, Intermediate Holding Company, and if you're working for a larger foreign bank, right, then they all have to comply with this, and this is a big thing for 2016. A lot of companies have been struggling and spending a lot of money to be in compliance with this. Basically, what this regulation says is that each non-U.S. financial organization having U.S. legal entities with more than $50 billion of assets must have an operating IHC. So all of your Deutsche Banks, Credit Suisse, BNP Paribas, UBS, and so on and so forth, they all fall under this category, and they have to create that separate entity, which must be capitalized, which must be operational, which must participate in all of those capital analysis tests that Federal Reserve Bank runs. So even though those are non-U.S. headquartered institutions, they still must participate in those similar tests that larger U.S. institutions participate in. So there's no escape, and a lot of those banks have been working hard, like I said, at least in the first half of 2016, to be in compliance. Miffyto in European Union is another huge initiative, which is the second version of standard MiFID, where standard MiFID basically covers best execution and requirements for satisfying, customer orders prior to any of the orders that the bank will execute for their proprietary positions. With MiFID II, you're actually going into covering all different assets, understanding the markets, pricing markets, and performing required pre and post compliance prior to executing any orders. So you have to check on trends and prices, making sure that the price offered or price bidded is within a certain a threshold of where that security is trading in the market. And this is across all instruments, right? Across all instruments traded in Europe today. So this is a huge impact, especially in the OTC markets where the prices may not be so liquid, but still the banks will have to put in pre and post trade compliance controls that will need to monitor all this in real time and provide compliance clearance for all trades happening in Europe or by European institutions. There are some additional components to MiFID II, which is they need to regulate previously unregulated organized trading facilities, all those alternative marketplaces where OTC securities are traded. There are additional requirements for safety of algorithms and high-frequency trading activities. So again, basically, you have to put in those similar pre- and post-trade controls, order controls for algorithmic and high-frequency trading strategies that you're doing that you had to do for traditional market orders. And what that means is, because before, you had to care about any latency issues, any delays with your algorithmic and high frequency trading activities, because obviously that would violate your whole intention of executing such low latency transactions. If you need to add all those risk controls, all those pre and post trade compliance rules, obviously you can't really reach to those microsecond level results that you'd had before, unless you really invest into a system that can provide you the fastest performance possible just to complete those activities. There are also additional supervision controls that had to be put in place for derivatives market, and this coordinated with ISMA, European Security Market Association, which again, derivatives were sort of somewhat less regulated market traditionally, but with MiFID II, derivatives are actually following into all of the other asset classes categories. So there is a similar type of governance and coverage of derivatives transactions similar to all of the other transactions. There are also stricter requirements for portfolio management, investment advice. There are additional time-stamping requirements for all orders executed by portfolio managers, so that if there is an audit by the European central banks or the regulators, then there is a way of showing basically when the intention to buy or sell securities was first made, when the first contact with the broker was established, when the order got placed, when the order got executed, when the order got reported. So basically all of this information from the time stamping perspective has to be in place. And what that means again is that all of this information has to be gathered systemically, automatically, through different systems, has to be able to retrieve all this information. Basically, what this is it equates to much more data than previously needed to be gathered. One additional component here, which is similar to MiFID, but MiFID II again sort of re-emphasizes this, and that's what I mean by other investor protections, is that this best execution scenario. So before, the broker had to basically evaluate where the security is trading electronically, and wherever the best price is, send the order to be executed on that exchange or in that marketplace. With Miffyto, there is also a requirement of capturing all this information. So not only sending this information, but actually capturing. So when you, before deciding where to send an order, when the broker basically swoops through the market and looks for best execution prices, he has to capture the environment at that time to show that this platform where he executed this on had shown the best price. Again, what this means to us is that much more data, not just the order data that has to be captured, but all of the market data, all the information in the market at that particular time of execution has to be captured and stored someplace. Again, much more emphasis on data, big data, ability of capturing and storing and retrieving information quickly. Some other regulatory initiatives coming in 2016. There is basically Basel Committee, something coming from Basel Committee called Net Stable Funding Ratio. It's obligatory in the USA, which basically dictates that there needs to be some cash that needs to be held someplace to cover potential losses during the year. And again, there is usually an audit that is performed by the regulators, and depending on the situation with the financial institution, there is a certain quota that is being required for the bank to put together. And again, for banks need to also monitor their risk profiles in order to see how much cash they're holding, if they need to hold over that minimum or under the minimum. They need to really cover this and have a good handle on what is going on with their overall portfolios. Federal Reserve has another initiative called Enhanced Prudential Standards in the USA, where basically there is a requirement to build independent risk management function within the bank. So right now, or traditionally, what's been happening in large banks is that the risk management was handled by each unit, right? So if there is a wealth management unit, then risk management within wealth management was monitored. If this was a brokerage unit, risk management there was monitored. If this was a retail function of a bank, then a risk management of that business unit was managing risk. Now, what the Federal Reserve is requiring to do is for those larger financial institutions that have multiple business functions or multiple business units under their group umbrella. So Federal Reserve tells them to implement enterprise risk management function, which again, in real time, supposed to gather information coming in from those individual business units for an analysis of the enterprise risk exposure and risk levels, systemic risk levels of that bank for the Federal Reserve mandate. Again, what that means is huge amount of data needs to be passed from all those individual business units to a centralized unit that's also going to look at this data, use their own reports, use their own scenarios, use their own risk management analytics to to understand whether there is an issue or not an issue, with the enterprise risk management situation of the bank. There's also a Financial Stability Board and Basel, which has a new regulatory initiative called Culture and Ethics Standard in banking, where again certain controls need to be implemented within the banking institutions. It's more in terms of not just traditional anti-money laundering, know your customer, different country specific regulations around that, but also some of the ethics standards, making sure that if the bank determines that maybe there's a conflict of interest or some kind of unethical transactions that's being performed, a bribery or anything of that sort, then there has to be a mechanism of capturing this, monitoring this, reporting on this, acting upon this, creating a case around this. Again, for us, that means a lot of data, lots of real-time analytics. One other thing is Dodd-Frank. Dodd-Frank has been around for a while, but now there are also living wills, which are put together as mandatory for banks with over $50 billion of assets. So basically, what that means is the bank has to create a detailed trouble resolution financial plan, file it with the government, make sure they're if anything changes within the financial situation or financial holdings of the bank, then they have to redefine that plan and re-notify basically the regulators about this. So again, that means active monitoring and anything going over a certain threshold, addressing this immediately. And finally, the enhanced consumer protection in USA. That means, again, additional controls for the banks to satisfy this, because yes, this regulation protects consumers, but what that means is that the banks need to do more to validate transactions that they believe may be fictitious, or that there's something maybe going on within that request coming in from a customer. So they need to do more on their side to make sure that the consumer is protected and the bank is not liable for anything any wrongdoing on behalf of the consumers that decided to act improperly. So what that all means is that the banks need to build controls to avoid further regulation burden, because we've seen what happens when the banks, yes, there's a lot of regulations, and obviously it's hard to be in compliance with everything, but we know that litigations are tough, and fines are very high, so the banks are taking it seriously and they're implementing all of those controls. Better anti-money laundering, right? So they're trying to monitor in real time where the money is going, source, destination of the transactions, whether this amount is in line with the previous transactions. All of this needs to be done in real time prior to the transaction to be approved. But at the same time, this needs to be done without sacrificing consumers' trust into the financial institution and sort of their comfort level, knowing that the transaction is going to be performed quickly. So again, that requires real-time analytics that is not noticeable to consumers, but at the same time strong enough and comprehensive enough to protect the bank from any potential suits from the government. Better KYC, know your customer. Again, there are new regulations around this, and not only the banks need to initially report information about their customer, but they need to keep updating information. If they see anything in the reporting bureaus, anything in social media, anything in the news about a particular customer, they need to reevaluate this. They need to record it within their customer relationship management system or someplace else where this information will be accessible by different units, by different systems, if that customer performs certain banking activity. This is, again, a requirement that the banks must comply with. And again, what that means is they need to build links to social media, to different bureaus, different entities where this information is being collected and used when approval for KYC needs to be done on a transactional level. Sanctions on cybercrime, again, there are many countries under sanctions, many companies under sanctions around the world. Again, we've seen serious fines being put onto various financial institutions when they don't take seriously those sanctions and cybercrime controls that were not implemented. Also, anti-fraud corruption and anti-bribery controls. Again, they need to evaluate every transaction, evaluate historical patterns for this customer, making sure that any of the entities that are potentially on the bribery lists are flagged if there is a transaction going through them. Again, that means maintaining this information within their systems, and before approving a transaction, going through those lists, going through those controls, validating them, and then the transaction must go through. Real-time trade compliance, surveillance, and monitoring. We've talked about this before. This is on the investment banking and brokerage and wealth management side. Whenever trades are involved, there needs to be a pre-trade and post-trade compliance, and both of those compliance levels have to be done in real time. It's not enough. Banks usually did pre-trade compliance in real time, but post-trade compliance at best at the end of the day when they were analyzing their trade activities for that day. This is not enough now. With new regulations, the banks have to do even post-trade compliance in real time. If they see that something is not correctly recorded, if maybe somebody traded a lot of stock before certain news came out about that stock, or maybe there's too much activity happening at the end of the day or around certain time of the day. Again, this information needs to be monitored, and if there are exceptions or problems within those transactions, they need to immediately be reported to compliance groups within the banks, and those have to act immediately on them. We know one bank, for example, that's now implementing their voice communications into this post-trade compliance initiative. So they are recording and they're monitoring, how the brokers are communicating with their clients or with other brokers, and if certain words are being used in the context of those communications, then the compliance officers are being alerted, and they can monitor anything happening with those traders and the prices that they're seeing in the market, and trying to, again, in real time understand if there are any issues for concern. So some of that we've never seen before. That again means a lot of data, lots of active monitoring, lots of systemic power to stop any of the fraudulent or unethical or problematic transactions. Supervisory accountability. Now, for each trade process or transaction process, there is a supervisor, and at least at the end of the day, they have to sign off on all of the transactions that occurred. But again, the banks are changing this because the compliance is monitoring transactions in real time. They also require that the supervisors are also monitoring activities of their traders or activities of their tellers or activities of their portfolio managers, depending on the business unit, in real time. And again, the systems must monitor this, and if something is not right, they need to alert the supervisors, in even prior to compliance officers or simultaneously with compliance officers, so the action can be taken care of right away, or an issue raised immediately too. So proactive monitoring, we discussed this now. They're also reviewing of client relationships in risky countries. And again, this goes back to sanctions and some of the countries that are known to be on certain lists to have additional scrutiny. Again, if there is a transaction happening with that country, there has to be an additional scrutiny. Again, most of it today within banks are happening electronically through some kind of systems. Again, data is being raised, analytics is being done, and alert levels are being raised. And then there are ethics code and accountability for conduct issues across the bank. So again, whistleblowers, any kind of issues that may be happening with accessing data that people are not supposed to. So all of this needs to be monitored and reported if something like this is being detected. Now, so this is basically the regulatory environment in which we operate. Now, what the banks are doing from the technical perspective on doing something like this with the key trends that's happening. Obviously, with today's environment, they can't really um, operate in a traditional sense, so they need to utilize technology for that purpose. So obviously, the fintech firms are targeting profitable aspects of the banking business. Some of those are because most of those aspects are electronic in nature, so the banks are not the best players or not usually the most experienced players in addressing those, and the new technology companies are coming over and taking some of that business away from the banking business. And we see that in all of those different categories, in payments and lending, investments, core banking. So there are lots of examples where this happens. Number two is that technology is evolving, that the banks must adopt to retain customers, and the banks are trying to navigate new technologies, a lot of open source technologies that they're looking into. They're trying to partner with technology firms. They're trying to create innovation labs where new technology are being tested by the banks, again, to make sure that they can address so much data that they accumulate, all of the analytics around this data, for real-time monitoring, for transaction processing, for scalability. They need to find the right technology to do so. Digitalization is obviously another thing that, as I mentioned, most of the processes that historically had been done at the end of the day or manually are now being moved into real time. And, there are all kinds of electronic automated strategies and processes that are replacing anything manual that the banks traditionally had been using. Cloud is another big category here. The banks are trying to invest into cloud because of scalability, because of ability of easily move more data, less data, reuse data, having better access to data, having all of the data in one place. So, removing silos. So that's basically where clouds had traditionally played a role within the banks, more private clouds, but the banks are trying to experiment now with hybrid and public clouds as well. Now, banks are also trying to simplify architecture and get rid of legacy systems, because obviously with new data, with new approaches towards data, there is a much more emphasis on the banks of finding technology that's faster, and that's not normally the legacy technology that they're using. So some of the projects that the banks are engaged in are replacing those legacy systems with something new. There are also blockchains and distributed ledgers that everybody's discussing right now, of improving performance, of improving time that it takes to execute trades, to clear trades, to change the registry under trades. Everybody's playing with those technologies too. But again, even if you are engaged in the distributed technology, you still need faster systems that are able to, generate smart contracts and exchange information quickly with other units of the banks. You're still getting to a system where, getting to a point where you need fast, high-performance systems to handle this data exchange. Big data and advanced analytics is an area where traditionally the banks had invested into. As the data input increased, as the data storage increased, as the data mining activities increased, there needed to be a better way of accessing this data and storing this data. And big data is one of the technologies that we see used quite often by the banks. The only problem with that is that it's too slow. Again, if it's a disk-based big data initiative, big data storage of some sort, in order for the bank to actually uh, run through those controls, big data related controls on the transactional level, it's so slow that the transaction, there is a definite performance effect and customer effect on noticing that the transaction has been significantly slowed down. So we think that the grids and in-memory computing is really what is here to solve some of those problems, that the disk is too slow to trade, process events, or perform risk and compliance functions that we talked about, and parallel systems to provide needed scale. So basically, it's those two issues that we've seen throughout this discussion, performance issues and a need for scalability are two problems that have been there for risk and compliance functions to address, and grids and memory computing and our platform we believe is the best source of doing so. Traditional computing versus in-memory computing, where you are, you can do anything you've done before, but hundreds of times faster than before, and you can easily add more and more nodes to the cluster. Then I go through the presentation that I've done. I've shown some of those slides last week, so I don't think I want to go into the details in those slides, but what I wanted to show you is how some of the banks are using our technologies in addressing the issues that we've discussed. So basically, here at least some of the banks, some of the financial institutions that are using us, and a lot of them are using us specifically for risk management and compliance and monitoring that you can see here. I would say those are probably some of our biggest areas of success within those larger financial institutions, because this is where most of the data is being accumulated. This is where the analytics needs to be performed very quickly on the data, so that transaction can be proceed without much effect on the customers, and that's why the banks are choosing our technology. So, for example, Sberbank is actually moving most of their transactional processing and analytics onto GridGain, where they basically they've evaluated more than 10 different competitors, and they saw that we are showing the best results in terms of performance and in terms of scalability, and they're able to generate about 1 billion transactions per second in a test environment, and all of this on 10 Dell blades, costing them about $25,000. So as we can see, because the banks need to be very cost conscious right now because of the financial situation, because of the cost of doing business, because of lower share prices on their stock. So we are providing them with that lower total cost of ownership, but giving them huge intake on the performance side. So I think at this point, this is where I'd like to stop, as we have only 10 minutes left, and I've talked a lot over this time. So I wanted to give you a chance of asking me questions about our technology, about financial landscape overall. Any comments you'd like to make, I'll be happy to hear them. And if not, then I'll be happy to receive that information from you electronically as well, and being in contact with you. Let me go back to the first slide where you see my contact details again, so that you can see where to find me. So this is my initial slide with my, oops, I don't know why it's not going there. Oops. Let's do it more traditionally. So Lisa, any questions? Do we have any questions?
We don't have any questions yet, but there was a question related to the deck and the recording. So the question was, can we get a copy of the presentation slide deck? And the answer is yes. I will make sure that after this event, after I have a chance to process the recording, you will all get a link to both the recording and the slides. And the slides will have Eric's contact information, and feel free to reach out to him directly with any additional questions that you might have. Okay, well, maybe give another minute for questions, and if you have them, please enter them in the GoToWebinar questions panel. Eric, we would like to invite you back for another in the series. Hopefully, we'll be able to do that in the August timeframe, and we'll make sure that all of you on this call will get an invitation to that event as well. Okay, Eric, I don't think there's any questions. You must have done a super duper job. I really appreciated your presentation. I found it very informative. And audience, I hope that you did too. And with that said, thank you so much, Eric. And audience, thank you so much for attending today's webinar. We hope to see you on a future event. Thank you again, Eric.
Thank you so much. Bye-bye.
Bye-bye.